banking on blockchain, lending tokenized assets, and the evolution of capital markets. We have, similar to last panel, we have somebody from almost every level of their panel, right? We have folks from the custody side, the traditional banking side, the tokenization side, the L1 blockchain side. And so I think we're in a very good position to answer a lot of questions. And I'm going to start off with the same type of question that I asked in the last panel to open up, where we were reimagining private markets. Why, much to Brian Moynihan's chagrin, would we move banking on chain? Maybe we could start with you, Matthias.
Well, in banking is about, why are we moving things on chain? It goes back to the very core proposition of the benefits of blockchains, which is that you can transfer anything of value between intermediaries, between two people or entities without intermediaries, on the spot, as long as you have access to the internet. And at the core, that is what banking is. It's helping people transact, it's helping people invest. And if you can do so more efficiently, you can have better products for people, because you can cut down on intermediaries, let's take, you can increase speed. You don't have the T+2 rails when it comes to USD or whatever, general fiat international payments. And ultimately you have a better service for clients. So at the very core, I think that's what it is. But it only works when a few things are in place, and that is where we are now moving towards, namely that you have enough relevant players, have regulated infrastructure as trusted nodes to do that. Because what does not go away is that a security on-chain is still a security, and securities laws still apply. You also need to have both legs on-chain, namely the fiat leg and the asset leg. And now with what's happening in the US with the 180, but also more broadly internationally, all these bits and pieces are finally starting to come together. And so, yes, I do believe that over time, in the next 5 to 10 years, banking will truly move on-chain.
So traditional banking is clunky. The on-chain capital markets seem to be a better option for the future and some form of the current market. And then I guess in the world of custody and tokenization, and I guess this varies depending on the jurisdiction you're in, where are we? I mean, Carlos, you've been building Securitize for as long as I can remember. And
as long as you've known me.
As long as I've known you, which is never long enough. Do you feel as though it was sort of a J-curve event for what you were doing in the tokenization world, where, I think we all were looking at, tokenized student housing in 2017, and that was going to be our gateway to the tokenized finance world. And really just in the last maybe 24 months, things have kicked off. Do you feel like we are at a capitulation point that requires an additional, I don't know, what can you call it, regulatory bill to uncap and really scale? Or are we at a place where you can continue to grow and you think your broader tokenization world, we won't talk about Securitize specifically, but tokenization on the whole has a chance to really take hold?
So I've started the company 8 years ago. So it's been 8 years, out of which the first 6, not a lot happened. A lot of silly projects, not some of them done by us, some of them done by competitors, but a lot of attempts to bring tokenization to mainstream that didn't happen. And I think it didn't happen for a variety of reasons. One is, first, tokenization platforms, technology, licenses, etc., were all very rudimentary, and the TradFi people that have the interesting assets were not interested in coming to the space. And the crypto people also had no interest in anything regulated, and tokenization, for the most part, involved dealing with securities. And as Matthias said, tokenized securities are still securities, no matter what crypto people want to tell you. And they didn't want to deal with anything regulated. And then I think the last 2 years, and especially, there's 2 things that have happened in my view. One is BlackRock entering the space, which is the largest asset manager, and their CEO going to CNBC even more frequently than you do, talking about tokenization and saying that this is the future of asset management, and eye-opening. And then not only talking, but actually coming into space, doing and launching what became the largest asset in the industry in a very short period of time. And then more recently, the new administration basically confirming that as regulated entities, we can use any ledger technology we want, and particularly if we want to use Avalanche, I can use Avalanche. And as far as I comply with my obligations as a regulated entity, what ledger technology I use is not their problem. So I don't think that we need any more regulatory unlock. I think what people are trying to do now is to actually try to get with things that you cannot do with traditional equities, that you can do just because you use a different technology, which I tend to disagree with. Ironically, crypto people used to say, oh, we shouldn't be regulated differently because we use a different technology. And now they're saying, oh, we should be regulated differently because we use a different technology. But from a regulatory perspective, there is nothing that needs to really change. And I think the Clarity Act does clarify some things in terms of like, DeFi UIs and stuff like that. And it just basically says tokenized securities are securities that still be regulated by the SEC. You still need to comply with the same rules. So go ahead and do it. So I do think that we've seen a massive growth in the last 2 years. Our company has experienced a massive growth in AUM, revenue, etc. But we're going to, see a lot more happening in the next, 3 to 5 years.
And now we're soon to be a public company, right? There's a
hopefully 30, 45 days away.
Congratulations. Very good. And then, so when...
And we're going to tokenize our own equity, of course.
Obviously. And then, of course, Copper's going to custody the asset itself.
It'll be on
when the whole world is tokenized, thanks to Securitize, and I have my Securitize tokenized equity, and it's going through the roof, you'll be my custodian of choice. Are you prepared? Do you think the industry, the market, or companies like yours are prepared for the entirety of internet capital markets?
I mean, the entirety sounds
quadrillions that Talia mentioned earlier.
Quite daunting, but I think, if, like Carlos said, if you're prepared to partake in financial markets using a different technology, then you are. So, I think it requires getting the right licenses to deal in the right types of asset classes, which largely most jurisdictions define as money, commodities, or securities. Right? There's, I guess, real estate might be some. I don't think that the technology limitations are a problem, and I don't think the regulatory limitations are the problem. I think the real hindrance so far to uptake in tokenization has been use case, because I think there's been a lot of attempts to do things that didn't solve problems that were hard enough to solve in traditional space. And I think what we're seeing now is that because of the tailwinds politically, the tailwinds regulatorily, and the institutions taking over the space, that we're seeing a lot more of those use cases. I mean, I'm not a case study. I am better lucky than smart. I joined on November 5th of 2024. I joined the entire industry that day, and that was
you timed it well.
Timed it well. Better lucky than smart. But I think the reason I joined, right? The reason I turned from being a crypto skeptic and a blockchain naysayer into a participant in this industry and getting to work with the team at Copper was because I lived through the Lehman Brothers weekend, and I was running a derivatives trading desk then. And the institution I worked for at the time went from having a $200 million exposure to Lehman Brothers on Friday morning when we received collateral from our Thursday night marks to having a $2 billion claim that we filed on Monday. And that was market move that when I watch what we do in crypto now, not we Copper, but the industry does in crypto, it's constant 24/7 mitigation of credit risk. And I think that ability to not be beholden to COBOL mainframe batch times and processes that are designed for other use cases, the ability to customize your use case for your use case is super powerful, right? I mean, I think if you think about, there's $1.3 trillion of initial margin posted around the world for derivative exposures, and how much of that could be reduced because it's posted there because I have to take a bunch of collateral on Friday because I have no idea what's going to happen on Monday, over the weekend when I show up on Monday. But if you could half the amount of initial margin that's out there, that's $650 billion of trapped liquidity that could be used for capital formation or for lending and leverage and economic growth. So I think that's the real unlock that we're seeing, that people are now recognizing, because the financial institution that is regulated and has to hold capital is coming into the space. I don't know if you guys disagree, but that's what we see.
So you are a blockchain yaysayer now?
I am a blockchain yaysayer. I'm still a little bit of a crypto, what is this crypto thing? But
we'll get you into some of the memes. Okay, why are you here, John?
we can ask Nicola.
So solving
Can you ask the question again?
So solving some of these problems, which you mentioned were too difficult to solve before. So Avalanche, in my opinion, has one of the best enterprise partnerships, business development arms. I'm not just saying that because you're here. But anyone with a problem that's trying to solve it on chain, I often refer them to Avalanche and what you guys are doing, because you are very, very interactive. You're highly interactive with your partners. And maybe for the audience, you can dive into a little bit as to why an L1 is sitting on this panel with a custody, tokenization, and banking partner.
Absolutely. I mean, we work closely with everybody on this panel and most people here. So I'll take a step back. And the way I like to frame this is, I think you've seen on the blockchain side, on the technology and infrastructure layer side, I think you've seen over the years, first, second, third, fourth, fifth, and however many generations of blockchains that improve the technology incrementally on the margins. They're a little bit faster, a little bit cheaper, they're a little bit more decentralized, insert whatever special feature they have. And their products technically have always been their token. And then they use that token to go and find users and use cases and product market fit. They're effectively a solution in search of a problem. Where Avalanche is different is we have our own public permissionless layer one blockchain. But what Avalanche really was built for from day one, the vision was tokenize the world's assets. And in order to do so, Avalanche has the ability to launch your own custom or purpose-built blockchain. So effectively, Avalanche is the blockchain platform for businesses, whether governments, including governments, institutions, asset managers, enterprises, innovative startups that want to launch with a blockchain as their digital backend from day one. We allow for that. We've worked with governments and institutions across the world. So if your asset class or your business is requiring certain jurisdictional requirements, you can bake that into your own blockchain. If you have compliance or KYC or AML requirements, you can build that into your blockchain. If you want a permissioned private chain, which effectively is what a bank is, right? Or a permissioned public chain, which is what enterprises really are, or a public permissionless chain, which we see more on the crypto side, we have the ability to spin up any blockchain to serve any need built for the business purpose or the asset purpose. So when you say are all blockchains, are all banks going to effectively be on a blockchain? I don't see why not. In the same way that blockchains went online 20, 30 years ago, they're going to move on chain. It's just a replacement of the technology backbone that allows it. I don't think that current blockchain technology solves for that, because it's, you know, it's much more a religion than a solution to a problem or a business. For most ecosystems, we like to say, well, you know, we provide the technology that allows your business or your use case to scale. So every account at a bank is effectively a wallet, right? Every bank could be its own blockchain with intra-bank settlements, and then you connect to other banks, and now you have interbank settlements, and now you're effectively recreating an ACH, SWIFT, SEPA, Fedwire, name your international coalition or consortium. It's just a faster, better rail.
Can I add something? Because
Yeah,
I'm a part-time Avalanche salesperson. So we recently,
I owe a lot of people money.
we recently filed for, well, recently took like 2 years, but whatever, for an application in the European Union to get something called a trading and settlement system that basically allows you to use a blockchain to settle securities trades, eliminating the need of a central securities depository, which is the layer that a blockchain. Is Talia still here or not? Because this is the layer that a blockchain is intermediate, which is the central securities depository, because their role basically gets eliminated by using a blockchain. And we did the filing with using Avalanche, demo the whole system, etc. To get a license, you have to have something working. And one of the things that Avalanche has that is interesting for securities regulators, and this was with ESMA in Europe, is that it has deterministic finality. In other words, when you move a transaction and you put a new block on the chain that, you know, closes a transaction, it's final. And nobody can touch it. And there's all the blockchains that have probabilistic finality. So it closes, but the block can be reorganized. It can happen later. Have to settle another chain later, etc. And that actually, you know, has advantages in some respect. But for securities, it creates a problem, because maybe you've registered a transaction of a security, which could be as, you know, we were talking here about billions of dollars, and then suddenly, like a few hours later, a few days later, you have to unwind it. So these are things that, as the institutions are taking over, that these things become more relevant, right? Like the specific features about how this underlying infrastructure work to build real applications in capital markets become much more important. So.
Okay, so I guess back to the title of this, we'll touch on institutional lending. I think one of the bigger breakthroughs on BUIDL was its acceptance as collateral, and we talked in the last panel about looping a CredX on Morpho for 8% and being able to finance a private jet in that facility. And then, but I do think, I mean, BUIDL is at the moment a very widely distributed product. And again, similar to ACREDX with a great backer in Apollo, BlackRock. It's
right. We were the ones that tokenized $150 million of ACRED before the ACREDX version happened.
Correct.
And it was already available in Lipscale, in Solana, and Camino, and like many other lending protocols. Whatever you heard in the previous panel is not news. So
it's securitize.io is the so we're going to get the ACRED.
No, we don't do it in our own protocols. We integrate with DeFi protocols that are adapted to permission assets, because obviously RWAs are permissions.
But again, I think going back on the lending side, the BUIDL product has been now, I don't know the exact figures, but it is widely accepted as collateral in the lending market. Maybe you guys can touch on that a little bit more in terms of, again, for the audience, give me an idea of what type of yield you're generating from that, what the borrow rates are on this type of product, and again, how simple is it to actually, who can I go to actually, would be a Copper and a Signum, for example, to be able to leverage these new markets.
So there's two collateral use cases for, let's say, BUIDL or ACRED or any tokenized asset. One is I'm on a derivatives trading, and then I post it as collateral instead of posting, let's say, stable coins. And because these are tokenized treasuries with a large asset manager behind, what happens, and they offer a yield, then first, your collateral is earning a yield while you're posting the collateral, and second, the collateral has higher quality, and therefore you can actually borrow more on the derivatives trading exchange to do it, and both, Signum and Copper, they both do that thing, and we work with them. And there's other kind of collateral, which is I'm going to borrow against the asset to lever the asset, which is not necessarily works well for treasuries because of the yield is lower than the lending rates, but it works well for other assets like, let's say, Acre, where Acre has 10-12% yield, and if you can borrow stables at 6%, then you can lever the asset because you can just buy more of the same and amplify the yield. And the first morpho integration that was done with Acre like a year ago, we amplify up to like 18%. So those are kind of like two different use cases where both is basically taking a collateral that is a real world asset that has higher quality than the traditional collaterals that have been used in crypto that are either stable coins or digital assets that are very volatile, and therefore the loan to value is very, very low. So, and then
maybe I can add just to specifically from a bank's perspective, right? The key theme for which we're excited about more things moving on chain is a key topic of growth for us, which is the off exchange custody. I'm sure you can also touch upon it. It's that this, let's call it segregation of state and church also in the crypto and digital asset banking ecosystem, namely that custodians are custodians and exchanges are marketplaces where you go and trade, and you want to leverage a custodian's technical, procedural, but also legal setup that you can remove the counterparty risk of the marketplace. That means the exchange. And in Switzerland, for example, as a bank, you have to make sure that these assets, be it on chain or not, that they're off balance sheet. And as a result, for the particular institutional clients that are coming in, they have a huge benefit. And this can be done in different ways. You can do it with US Treasuries completely not on chain, and you right now see we're integrated with various exchanges. Some accept only crypto, some accept crypto and US Treasuries, some accept crypto US Treasuries and BITL and other tokenized money market funds. And the key difference, or one of the key difference between doing it with the US Treasuries versus doing it on chain, is exactly moving, or let's say the more we can move both the cash and the collateral on chain, the easier it gets to reduce the trapped collateral as you outlined, namely that you can also, it's 24/7, so you can recollateralize, you can cross rebalance between exchanges or during the weekend, which in traditional finance is simply not possible. And so we see year after year this whole let's say liquidity management becoming more efficient, and I think we're only just getting started. Last point I want to make is, what is interesting is that actually the exchanges, at least for those that use this product for crypto trading, they're a bit the kingmakers of which such on-chain assets are allowed. So a lot of the discussions, I'm sure Carlos and also I and other gentlemen here, we all have, is exactly which exchange accepts which collateral as off exchange. So they're a bit the kingmakers in this whole process.
And how have they historically, in your interpretation, how they historically decided the exchanges?
It comes with liquidity. What is my liquidity? What is my ability to turn that thing into the cash I'm going to need, or the stable coin I'm going to need to pay off?
I like to use it interchangeably now. That's nice.
You can, right?
Yeah.
It is. And I think, this part of the catalyst that has really increased awareness about this, especially for the derivative trading use case, is interest rates actually matter now. 3 years ago or 4 years ago, rates at zero in ZERP, you don't care that you're not earning interest on your collateral. But now, in order for the trading venues in the native crypto world to compete with the CME and other more established clearinghouses, which pay interest on deposits and which allow for treasuries to get posted as collateral for initial margin, these the trading venues need to compete so that you're getting the same return, same effective return, and not having to pay that interest rate drag. So I think that that's also a key consideration, is the clients need to be earning a healthy yield, which comes from products like BITL, treasuries, right? It needs to be safe and liquid for the trading venues to assume that it's going to be good collateral. And then it needs to be relatively freely either transferable or turned into a transferable instrument.
I'll tell you one thing that Bill, who the CEO, the founder of Jump, who is actually here for the first year, just having coffee with him, he told me like, I don't know, like a year ago or something like that, something that kind of resonated very well with me. He said, look, Jump does trading both traditional assets and crypto assets, right? They do market making in both. And he said, in the traditional world, I have very high quality collateral because I have treasuries, I have a money market fund from JP Morgan, etc. But it moves very slowly, and I cannot borrow on the weekend or etc. And then crypto, I have very fast rails for moving collateral very fast, but I have very bad quality collateral because I have to rely on stable coins that they peg or on crypto assets that are very volatile, etc. So I see tokenized RWAs as kind of like bringing the best of both worlds, right? High quality collateral that moves crypto rails and crypto speed. So I think that's very important. Now, the challenge is that if you look at how a crypto exchange operates, the collateral that they accept is also a trading pair on the exchange to liquidate it there if they need to liquidate it. But when the collateral is a security, the crypto exchanges don't have licenses to liquidate within their own exchange the collateral because it can't trade securities. So that has created friction to get these integrations done with the crypto exchanges, and slowly it's moving towards there, be figuring out the ways of liquidating the collateral with on-chain liquidity and stuff like that. But that has been one of the frictions of getting this use case accepted in the crypto exchanges.
I think something that you bring up that's important, Carlos, and I think where the technology really has to help change this is, I mentioned that I think the crypto industry for the most part is still stuck in a first generation business plan problem, and they really haven't moved on from it, right? Custodians are catching up in a good way. Banks are catching up. For the most part, analytics sites, wallets, exchanges, all the business models that currently exist to serve what's been happening in the space for 10 years, right? So added support for a new blockchain, maybe add support for some of its assets. It's an integration fee, it's an indexing, it's all this extra work that needs to be done, and their salespeople are incentivized to do so. But in order to take on this new world with institutional collateral and securities and commodities and a million other different assets, you're going to need different rails, right? You're going to need different licenses. You're going to need different kind of setups for this. And I don't think the industry is really shifting towards that as quickly as they should. So you have outliers that are really taking the next step to build better products, institutional products, supporting the institutions that are coming in the right way. And I think maybe with or without the Clarity Act in the US, which should help. But for the most part, there's still opaqueness there. And there's still this old mentality of thinking that is not as supportive of this next leap forward at the technical and infrastructure layer.
Who are the ones that are doing it well, in your opinion?
I won't answer that right now.
It was an easy tee up to just mention the names on the panel.
Well, no, I don't mean you guys, but I mean just in general. When I look at like five analytic sites, and every single one has a completely different metric for how much value or how much in stable coins or how much in tokenized, like every single one uses a different methodology. And then you go and ask them to fix this or to correctly support it, and then they come to you with an integration fee or an fee. Like, right, exchanges are the same way. They support your blockchain, but if you're a private blockchain or a permission blockchain or an institutional blockchain, like we have FIFA has a blockchain on us, and they're doing collectibles, and they're gonna do payments, they're gonna do ticketing, they're gonna do all these things. Well, now FIFA has to go to Binance or Coinbase or any exchange and be like, hi, put me in the back of the line, or I'll pay you more to put me in the front of the line to support my blockchain for my assets. Like, the world is not gonna wait for the exchanges and the infrastructure providers to continue being the gatekeepers from allowing people access to the assets that should have always been and are coming on chain now.
I think a few World Cup tickets would suffice.
You'd think so.
I think FIFA knows how to get decisions made in a different direction. That's one thing I've learned.
That's true.
They have a history of.
So I guess rolling into that a bit. So banking on blockchain. If Matthias and Signum came to you and said, we want to build our own private label chain on Avalanche, what does that even look like for actually from your perspective, and then maybe from your perspective once you hear what he says?
I mean, we do this work with banks right now and asset managers, and we do it. We did something similar with a consortium of 5 banks in Saudi Arabia under the guidance of SAMA. They needed a permissioned private chain. We provided that. All the nodes had to be located in the kingdom. We can do that. First, I'd ask, what are the compliance requirements that are needed, right? How many nodes do you need? So there are multiple third-party providers. Ava Labs has one as well. That is blockchain as a managed service. People like to think blockchains are now so difficult and they take 3 to 5 years of R&D for an incremental improvement. It's really not that difficult anymore. We've commoditized it. You can spin up a blockchain in 5 minutes if you really wanted to. That's pretty basic. So first things first, what do you need? Right? What performance measures do you need? What kind of decentralization distribution of nodes do you need? What's the jurisdiction requirements? And we can work through that rather easily with the solutions architecture team and spin up a chain with whatever gas structure or no gas structure, fee structure that's wanted, and just stand that up in the course of several days or a couple of weeks.
And for you, is it a technological decision, a regulatory decision? I assume a bit of both, but how do you think through that scenario?
Yeah, first thing is probably the technological decision is, of course, important, but probably it's a bit, probably 10, 20% of the equation. The rest is really how to integrate that part into the overall banking infrastructure that is still needed today, integrations, and ultimately for reporting to the national bank, reporting to the regulator, the core banking system, the link to the fiat system, the ledger, how do these systems talk to you? How do you make it from a UI standpoint that people don't realize that you're basically, still converging, managing the convergence of two worlds, because today we're not yet fully on chain. Not everything is on chain, so we need to manage both. So that will be a key consideration. And then of course, that's why you said the word compliance 4 times in 30 seconds. That's obviously a core consideration. And the regulatory part, probably would spend 50% of the time trying to work with the regulator to accept that chain and that setup. That probably will be something like 40 to 50%. The technical part 10 to 15%, which by the way speaks for the technological solutions. It's not that complex anymore. And then the rest is integration in the other systems.
I mean, we do this too, though, right? Like, we're not just out here talking about the merits of the technology. We work with the institutions as well, and we work with the regulators as well, right? We constantly have to do education to explain that on-chain is not that different than online, right? And the same things can be built in at every level.
On-chain's a new database.
That's
what
it.
it is.
I mean,
I think Christina mentioned on the previous panel, right? I think the biggest issue is that what we're talking about here just put the entire audience to sleep, right? Compliance mentioned 4 times, regulators. It's like, that's not what people came here for. This is crypto, man. Where's my Lambo and my laser eyes bull? Like, this is what happens when you get traditional finance, banking to come onto blockchain. And what do you have to consider? And I think it's the reason that some of this hasn't taken off so far is because it's the unsexy part of finance. That's what we're really, blockchain is the underbrush. We're not the frontline traders that are, mine yoursing $1 billion up markets, but we are the settlement rails that allow a lot of finance to occur. And that takes time, patience, attention to detail, things that in my brief experience in crypto doesn't come culturally to crypto native, because spreads have been wide and returns have been high. And so do I need to be precise? No, because am I going to make 25% or am I going to make 23%? That's not important. I'm going to make a giant percent. And
but,
so I think,
but I'll say it's both, right? Because I will make the argument that at how many times is retail, for the most part, who's been involved in these cycles, going to keep on coming back to the same well and leaving thirsty? Like, you can only extract so much from retail over and over and over again. And I don't know anything in history that's been that super fun and exciting, that's moved that much. It's the boring stuff on the background that sets the foundation for the cool stuff to be built, right? If I was to ask anybody in this audience or here today, like, what's been the killer app of crypto over the last 15 years?
Speculation.
No, but name an app. One does not exist, right? We have not yet had an aha moment that has delivered a new product using the technology. We just make everything better that currently exists today. We don't have the email moment for the early days of the internet or social media for Web 2. We have not done that because it's been highly speculative and not delivering that value.
But arguably, tokenization is an app or a use case.
Yeah, stablecoin is tokenized money.
Stablecoin is tokenized.
But you're not going to put BlackRock's BUIDL and bank settlements and deposits and exchange and all this stuff alongside meme coins and NFTs and God knows what the newest thing of the week is, right? Like, at some point, every institution says to us, we are more than happy to go on chain, but we don't want to be validating activity that could be illicit, illegal, or sanctioned with other people. And you don't have a solution for that. Or sorry, the industry has not had a solution for that. Well, that's why you silo everybody into their own flow and you make it interoperable.
I don't know, but the internet also has illicit and licit activity, and people use the internet, right?
True.
As far as they're segregated.
So nobody's like a bank is not using the same server as like an online casino.
Not the server, but the same rates, right? Like,
wow.
So reputational preservation, I suppose, is a bit of a concern for the traditional folks coming in.
It's interesting. Like, I mean, we did the first, like, high-profile tokenization project. We did with Avalanche, coincidentally, when we tokenized KKR. KKR was like the first asset manager. They decided to come on chain and tokenize that. And guess what? The next 2 weeks, my phone and my email was blowing with like people wanting to do that. And then, then Terra Luna happened and Celsius happened and BlockFi happened and FTX happened. And then it completely evaporated because the answer was, we don't want to have any, reputational impact for being in the same industry where you have like people, being taken custody with, handcuffs and going to throw in jail or
no banker wants to wear orange jumpsuit.
So nobody wanted to touch it. We actually had, with one of the top 3 banks, a project already about to be signed, and the chief strategy officer, he called me and said, like, we're canceling. The bank has prohibited any interaction with anybody that touches anything in this industry, period.
I mean, that's...
And I worry, by the way, with the new wave of tokenization and all these shenanigans happening, or some people doing clearly illegal stuff with tokenization, that the same thing will happen again. and we don't seem to learn as an industry anything from the past. So,
well, this is, I mean, 8 years later in crypto, I mean, tell folks, what do you do? I mean, crypto, you still get the head tilt still.
I
Do you say
still-
finance?
No, I
feel
tell
like
my
you
friends I work for a blockchain fintech. I do not work for a crypto
Ah.
company.
I say,
And actually,
I
that is
go
mostly
crypto,
true.
hard C on the. I'm crypto. I like the little bit of fear that glazes over them when you say it. All right, we've got a minute left. What's the newest bit of information or news that you think is enormously impactful that maybe people hadn't necessarily viewed as such in the last 3 months? Give me something that you think is just incredibly important that this audience should know that maybe they brushed over.
I don't know if people brushed over it, but what I've noticed, and it's not a piece of news, but the increasing use of the word privacy whenever somebody's talking about both crypto or blockchain, I think is really interesting because it is so antithetical to the initial reason for blockchain, right? Sunlight is the best disinfectant, kind of transparency of all activity that happens. And I think collectively, the ecosystem is realizing that there are use cases for privacy, right? That this is a spectrum of, there are times where everything transparent is great. And there are also times where none of us here are going to publish our Chase bank account balance on the internet, right? I'm not leaving that open for everybody to see. It's a very small number, by the way. So it's just because I'd be embarrassed. But I think, that's something that has, I think, been a little bit of a sea change that people may or may not have realized.
So from my side, I think there is one article that Hester Peirce, which is arguably the most crypto-friendly commissioner on the SEC for the last, 3 commissions. She published an article that the title is "Tokenization is enchanting, but not magical."
Yeah.
Which she basically said, don't think that because you use the word tokenize whatever, you can just like do whatever you want with securities. Tokenized securities are still securities. Tokenized derivatives of securities are also securities, and you have to still comply with the law. And this comes from the most crypto forward friendly person in the commission. So tokenization doesn't change the nature of the asset, it just gives better rails for the asset, and that's it. And anybody that tells you differently is just.
She'll be coming down to visit us in Miami in the end of the month.
I know, I'm actually speaking at the same conference.
Yeah. Very good.
I think in short is that because it's not in the news, I think if you speak to people here throughout these days, I think the general public and also maybe even us here, we underestimate how much is happening behind the scenes. All of us doing collectively with institutions that have taken the strategic decision to go in and embrace this technology, but are maybe a bit slower. It's a 12 to 18 months kind of cycle that then will accumulate over the next, again, 6 to 12 to 18 months into a massively increased network of trusted nodes that can interact with these blockchains in a meaningful and obviously legal and positive manner. So I think that's underestimated. Last year, people were maybe a bit too bullish. And this year, I feel maybe the opposite could happen a bit less.
Healthy skepticism, which is good.
Yeah, which is a good thing.
Yeah, strong close, John.
Jeez. 3 months is like 3 years in this industry, so I can't even think that far back. But I would agree with Amar that I think the rise of the importance of privacy. I think the signaling that rules exist and you can work within them, and the ability to do so. I think someone was speaking about this earlier today, that private blockchains are going to start to come back, but they're going to come back because they're connected to public blockchains. And that interplay is really, I think, going to drive us forward across different asset classes in different jurisdictions. I think we're just at the cusp of that. So exciting times ahead.
Wonderful. Thank you, gentlemen.
Thank you.
Thanks, Mike.
Jenny Johnson, who needs no introduction at all.
With this crowd, I might.
It is traditional in crypto to ask what we call your rabbit hole story. And so this is, when did you first hear about crypto and digital assets? But not you personally, you as a CEO, and how did you think about it? And how did you fall down that rabbit hole, taking your organization with you?
So
kind of the aha moment.
Yeah. So just a quick background. So my grandfather started Franklin Templeton. So I'm also in the family business. We're a public company, but we still have a big portion of it. So I'm third generation. And we're a $1.7 trillion asset manager. We do public, private, and we have clients in 160 countries, so really global. So I actually came up through the ops and tech area. So I first heard about this blockchain thing, and it was all about being able to have a single source of truth. One of the biggest issues you have running a IT department is actually the quality of your data and knowing kind of where it is and the latency of data. I always tell people, don't let the tech guys scare you. All they're doing is moving data around. And so you suddenly had this technology that people were talking about that had one single source of truth that was always up to date. And the amount of money that TradFi firms spend on reconciling data between their own systems, and then when you do a transaction, you have to go reconcile that data with your counterparty, is just a huge cost in the system. And so I was like, oh, that's really cool. And then they were like, yeah, but it's very slow. It's totally slow, and don't worry. So actually, it's been thrown back at me a bunch of times. I was like, no, this is really great, but it's not my problem. It's my grandchildren's problem, right? Like they won't use it. It won't evolve that quickly. So that was kind of the first. And then it was really a group, as often happens within the firm, that are kind of leading, sort of entrepreneurial pushing, saying, no, you should pay attention to this. And so at that point, it was probably around 2018. And we started to think, well, actually, this could be pretty interesting to try to launch a tokenized money market fund. And that was probably the beginning of those discussions in there. And so we almost did little pockets of things. So one was, all right, we're in the money market business. If this could make it more efficient and cost effective, that could be pretty interesting. And then the other thing, we actually had a fund that bought consumer loans that were peer-to-peer loans being generated. And so we went to Mike Cagney, who many of you may know through Figure, and said, we want to buy your loans. And he said, all right, great, but I'm doing it on blockchain, so it'd be really helpful if you be a node validator. I'm not sure, I certainly didn't know what that was, but our team did. We were like, all right, fine, we'll be a node validator. And today I think we validate on something like 13 different chains. And so we started to do that. And as you got into it little by little, you started to say, wow, there's something really here. And so, as often cases, you started out with almost little pilots and then start to realize, no, this is significant.
Yeah, but I want to dig into that a little more, because you maybe were, you were so early. And I think people in the audience now, and especially as this will be recorded, are going to want to know, how do we move our organization forward in the way that, because, nobody was as early as you, nobody substantial was as early as you. And so let me first ask you a quick org chart question. Where did this sort of entrepreneurial group, how did they report directly into you, or how did you make sure that you had some line of sight to these innovative ideas?
So interesting. I was not CEO at that point. I became CEO in 2020, 3 weeks before the lockdown. I think I was probably co-president. I don't remember if the group came out of actually an investment team. And they either reported to me then, or they reported to me soon after. And so more of what I was doing was blocking and tackling to make sure you cleared the way. I always say, if you're a big organization, anybody who's worked at a big organization knows how hard it is to get change. And if you run an IT department, your number one issue is never your technology. Your number one issue is change management within the firm. And it's never the tech guys, because they're already in it. All of you are that small percentage of people who love to try new things. But actually, most of the world is not like that. They like what they do, and they don't want to invest in learning to change. And so this group was there. And so what I would do is would get them the budget, which was still pretty small, and honestly tell them to ignore the eye rolling that was going on through a lot of the rest of the firm of why are we even doing this? What a way, look at this crypto stuff. And then anytime you had like when FTX happened, anytime you had a blow up, it was, see, I told you so. We shouldn't be spending our money. And I looked at that as, this is great, because it means my competitors will justify their position for not being in it. It'll give us a longer runway in it. And so I always would say, oh, those little moments give you more long runway.
Right. So, but it matters if your head of marketing is eye rolling and versus your head of compliance and legal is eye rolling. So what were some of the, I mean, we're all aware of a lot of these, obstacles get thrown at us, but was there anything there that kind of surprised you, or anything particularly difficult that you had to kind of find a creative solution to?
So I'd say it was akin. So I actually, at one point in my career, ran what we called e-business. And e-business, the definition was anything that had to do with the internet was under me. Okay, so and by the way, most people, if you're old like me, you'll remember that when the internet first came out, enterprises thought of the internet as a billboard, not as a communication channel. You just had to post like your contact information and your call center number, and you were good. You didn't have to think about it again. So then I was taking on anything to do with the internet, and we were trying to start to make it a communication channel. I am at that point the daughter of the CEO. And I could not get the marketing department to write material that would be appropriate to be consumed on the internet. They'd say, you're good. We have the PDFs. It's a 7-page, brochure. That's fine. Just use that. and so that's what I mean by that change management. And even if you're in charge, the resistance that happens when people don't believe in the kind of the mission of it is really hard in organizations. And so, again, that's that insisting, blocking and tackling, almost letting them create their own sub business unit. You have to give them their own salespeople, in some cases, their own marketing people, because it is hard to get that. I say, like, if you're growing a garden and it's filled with weeds and none of the nutrients can go to the plant you're trying to grow, it'll never work. So you have to protect it in those early stages. And to me, that's the only way, if you're in a big organization, a traditional organization, that you're actually going to have this take hold, or otherwise you'll join late. And that'll be fine, but you won't get those first mover advantages.
Right. Okay. So let's talk about that first mover advantage in the competitive ecosystem. Because if you are making widgets and you got there first, and you could convince your internally your organization, you're good, you're done. But finance, I like to think of finance as crochet. You look at the front of it, it's beautiful. But if you ever turn it over, it's like this absolute tangled mess.
Come on,
right?
We don't want people to know that.
So you can't move really without anybody else, partners and customers. And so how do you kind of inch that along? And
well, so that's the hardest part of it, right? Which your point is, like, we don't trade with ourselves. We trade with somebody else.
Right.
And if nobody that we're trading with has wallets to be able to do this, it's really hard to get a hold of it,
Right.
which has been interesting, because what it's done is it's opened up actually a whole distribution channel that we didn't exist before.
Tell us about that.
Partnerships that we're building with exchanges and with different firms, because and just back for a second, when we decided to launch the tokenized money market fund, we were like, all right, let's go find a service provider who could build the shareholder record keeping system. This would be great. Well, it didn't exist. So fortunately, we then built the platform on the Stellar blockchain. I think now it's on, I'm looking at my team, like 11 chains, I think. But we had to build it ourselves, which was not something that you would normally, as an investment management firm, would have to think about. You just go to JP Morgan and other places to do it.
Right.
So the willingness to do that was really important. And to be honest, even today, it is just this year. This is why I think 2026 is going to be a different year, because finally our traditional firms and distribution channels are coming to us and saying, listen, now we got to deal with this blockchain thing. Could you talk to us, educate us on it? Whereas the only people we could talk about our Benji, our tokenized money market fund with, were traditional or DeFi firms who had wallet infrastructure and had the distribution and had people who were comfortable with it as a distribution channel, but none of them have the traditional products. So now we're talking about working with partners on tokenizing ETFs and other things, because they're now trying to say, well, our clients want traditional products. So the point was, you're exactly right. If you don't have the partner who is already built on the infrastructure, and look at banks. First thing they did was they said, listen, don't get comfortable with these public blockchains. This is really scary stuff. You should use ours. We'll do a private blockchain.
Right.
Like, why? Because they're toll takers in the system, and their business model is directly threatened by all of what this can do. And so the first thing they tried to do was say, we'll build it on ours. So when they come to us, they said, no, you got to work on our chain. Now, I think what's happened, and I love to use the example of the Ethereum, where they went from proof of work to proof of stake. And I say to people, like, so imagine you've got an IT project in a big business. It's your entire backbone of your business model, and you have to make a complete architectural change, right? Which is when Ethereum made that shift, that was a massive architectural change, and it got delayed, and there was splitting off and different things. But the weekend it happened. And every business who had built themselves on top of that on Ethereum got the benefit of a massive IT project without any cost to them. So how are you going to compete if you have to pay for that yourself? So that was one. Number two, when I say to people in businesses, oh, and by the way, there was no project manager. There was no team. It was a community coming together to achieve an objective, and it went off without a hitch. So to me, that's should be a light bulb, that if you think you're going to build your own private chain and compete, then you're going to have a hard lesson to you, because you're not going to be able to compete with the community.
I think about always that Microsoft Encyclopedia project that was launched at the same time as Wikipedia. And you can't compete with them.
You can't compete.
All of these. Yeah.
Value of the crowd.
Yeah. And of course, you had a secret weapon in Sandy Call. That
I have and continue to have a secret weapon in Sandy Call.
She did. So, podcasts and appearances and conferences, just kind of spreading the word. And you know, Franklin Templeton has really evolved as like the bridge, honestly, between our community and the traditional finance community. You're credible with both ecosystems now, and so you serve such an important, I think, ambassadorial role both ways. So tell me a little bit about the incoming. Is it?
Well, what I find so funny, because I've been speaking at crypto conferences for, I don't know, for a few years now, and I would always be amazed at the size of the conference. And then you'd go to the TradFi world, and it was literally like two parallel universes that didn't talk to each other. And the TradFi would dismiss it as its niche. It's not going to really, it'll die out. And the crypto guy would be like, they'd be like, look at my $1 billion. I've made $1 billion now, you know? And so it is literally this year where I feel like there's starting to be enough demand on the TradFi side to say, we need to address this. We need to figure out.
Yeah.
And then also on the DeFi side, where those who have, you know, if you put Kraken and, you know, OKX and the different exchanges, Coinbase and others, they have these massive client relationships that they now want to offer traditional products on. So they're coming to the TradFi world looking for more traditional types of things, because in the end, you want to be able to provide your client choice. And so it's just an interesting thing, because I really think it's starting to come together in a way. Now, I have to say, because we do, you know, we have teams that run equity portfolios, I would always say to our teams, you have to be careful. If you're doing an evaluation on a company that is, and you're looking at the competitors of the company and you're trying to see how it's performing in the traditional public markets, and you're not paying attention to the DeFi world, because over here there will be disruption to the business model. So you're limited in the business model in the public world, and there may be something coming here to disrupt. I mean, I look, and I'll use examples like, you know, Helium with being able to resell some of your internet exposure, and that, you know, they have a huge waiting list. I haven't kept up on it, so I'm assuming they still have a waiting list. Like if you're evaluating internet service providers and you're not paying attention to this new model where the client is essentially becoming almost part of your IT department by being able to supply that that bandwidth, like you're not actually looking at the entire universe of it. And so I think that for equity analysts, they have to be paying attention to the business models that are being created here in DeFi.
Yeah, and some exciting things happening with 00 and other kind of infrastructure companies now. But can I ask you then, what's coming across your desk now? If we now look forward and we think about your positioning, but also just like from your vantage point, what have any opportunities surprised you, or what are you hearing and demanding from your customers?
So let me talk for a second about our tokenized money market fund.
Okay.
So, you know, what it's been able to do is to provide efficiencies. Now, let me first talk about cost efficiency. If you know our business, it's constantly fees. Fees are only going one way. There's pressure on it, right? So when we went to the SEC to get the money market fund approved, they required us to parallel process on our blockchain transfer agency system, shareholder record keeping system, and our traditional one. And actually, we did run 4 transfer agency systems kind of globally. It was kind of Fidelity and Franklin, which were the only ones who were still doing that. So we actually were able to run these parallel. And by the way, as I pointed out to my team, the first time anybody in the regulatory environment ever asked what the programming language was for the transfer agency system was only when it was on blockchain.
Wow.
Like nobody ever asked it before.
Right.
Suddenly they cared about the programming language, right?
That's amazing.
And so we ran it parallel, and it was like 6 or 8 months, and I think we did about 50,000 transactions, and the transactions cost us about $1.50 each out of pocket. It was $1.50 to run those transactions. The entire 50,000 were what, $1.13 total cost. Now, part of that was like, so remember, 50,000 times $1.50 and $1.13. So that was like, oh my gosh, are you kidding me? This different. Now that we picked Stellar, that was the right chain for what we were trying to accomplish. And I often tell people, like, you know, you got to pick the right chain for whatever your goals are. So that was really, really important. And so then we were able to, with our traditional money market fund, it costs $500. Your minimum purchase is $500. In the blockchain, it's $20. We could even go lower than that. But think about when we all talk about financial inclusion, like that's amazing that you can suddenly make it cost effective at that price. But then the other things are, we pay and post the yield every day in the account. And the only reason is because we're natively on chain. Most of the other money market funds are digital twins. So they shadow, which means when a traditional mutual fund closes at 4 p.m. on Friday, it doesn't open until Monday morning. And so you can't actually transact during the weekend or after. But because we're natively on chain, we can transact at any time. And what we can do is we can post the yield every day. Now, you're still getting the yield in the other money market fund, but guess what? From an engagement with your client, we first thought, well, that's cool. Like my daughter, I was telling the story about I pre-funded her wedding in the account and said, anything you save is yours, but you go over, it's on you. She goes, Mom, I'm getting yield every day in my account. I get it posted, like I get money every day. That was like, from an engagement standpoint, pretty cool. But you know where it's really getting interesting? So your point on surprising is if you're a corporate treasurer, right, and you've got to move money around, actually, when you have capital requirements, what you get posted in your account matters. You don't need to wait until the end of the month when you're talking about hundreds of millions of dollars that can help you with your collateral actually matters. And so we're finding these opportunities with just some what might have just felt like kind of cool little features that actually are going to really matter. And so then the other thing it opens up is anybody like a hedge fund, maybe who needs to post collateral, for partial part of the day, you wouldn't have gotten paid that collateral. We calculate the collateral every second. So you own our money market fund for 4 hours, 32 minutes, and 22 seconds. You're going to get paid for that. So think about where this ultimately goes. Now, if you're in TradFi, you roll your eyes and go, yeah, but who do people really need it? Well, we didn't need the iPhone until it was given to us and we started to realize, oh my gosh. Right. And none of us understood when we got the iPhone that it was going to be much more than a cool camera, telephones, and music, and maybe a flashlight. And it was when they unlocked the imagination of people who could build businesses and suddenly you could download them easier. That's the same thing going on here, right? Which is we don't know yet all those capabilities, but you already start to see the excitement when you start to understand as you unlock these, then the imagination starts to take off. So I think that's been the cool thing is realizing what this will do when you start to put traditional finance on 24/7, 365 days.
And that's during good times. I mean, I looked after the public sector franchise for JP Morgan during the global financial crisis. So I'm talking about like central bank clients calling me, how much collateral do I have? What's in our repo agreement? Like, I'm like, you don't.
How do you not know that?
Yeah. How do you not know this? But the transparency that you can give to a client that, can be smart and in a crisis and obviously in a wallet-based infrastructure, have a bit more control over an understanding of what assets are in their control.
I was going to add one other thing that I think we are only beginning to unlock and see, which I think is going to be transformational, is the smart contract components where and you add AI to it. And so the creativity that people are ultimately going to come up when they realize you can just program this in and it acts on its own, and then you add agentic to AI to it. I think we're going to get new types of investment products, new types of business capabilities that are going to get really interesting, that are going to be fueled by this technology. The reality is whenever you roll out a new technology, it takes years before people's imagination catches up with those capabilities. And to put that in context, for the last decade, US productivity was running about 1%. We finally broke through. It's running about 2.5% now. And none of it has to do with AI. It is all technologies, cloud services, other things that were rolled out 20 to 30 years ago that finally get absorbed into people's operating systems. And so again, things like the smart contract capability being tied to people's ownership and rights, and you add AI to that, it's going to be really fun to watch.
Yeah. It's going to be amazing.
Scary, but fun.
Yeah. So let me ask you, do you still have to run the parallel thing?
No, they only made us do it for, it was like 6 or 8 months. What was actually funny, one of the problems we had is that, your old mainframe, that was literally what we were running, I think the old system on, you were limited to, I think, 8 decimal points. Well, of course, you put it on blockchain. And so you're always out of balance because the blockchain system was way more accurate.
Oh, that's amazing. That's amazing. Okay, so as you think kind of about going forward in 2026 in particular, we have a much more, of course, benign regulatory environment in the United States. We had a lot of action talking about clarity even just yesterday and the day before. Do you any kind of crystal ball sort of things, not just about but not just about regulation in terms of what we might look like a year from now? Or
look, I think what's going to happen with stable coins and payments. I mean, that is the first sort of thing that is the most obvious use cases. And
talk to me a little bit about that.
Well, I think that, and it's interesting because those who are following the Genius Act and some of the regulatory environment in the U.S., there's this big debate: should stable coins pay yield? And look, there's a fundamental concern in financial systems. Stablecoins pay yield. Who's going to keep their money in a bank, right? And so, and in the U.S., you have a bifurcated system where if you pay yield, you're a security, and you have different laws. And if you don't pay yield, you're a bank deposit, essentially. So I think there needs to be a little bit more clarity. Other jurisdictions don't have some of that same use. I think in the U.S., it is really imperative that they keep those two things separate, or else they have to bring together their own regulation. But as long as the regulation, you can't have regulation arbitrage. That becomes a disruptive force in world. But that needs to continue to play out. But I think on the stable coin, and the payments, you already see it. I was talking to Caroline Pham from MoonPay today, and some of the interesting things about how you can pay with crypto online. Like that stuff's all going mainstream.
Yeah.
And so I think the adoption is going to be much greater. And listen, I mean, even Jamie Dimon's changed his tune on all this stuff. He's trying to kind of figure it out. And he did say to me at one point, well, Jenny, because I said, look, stable coins are going to affect people's, how much they're going to keep in their bank deposits. And he said, we provide ATMs and other services. And I thought to myself, of my 5 children, I'm trying to remember the last time they went to an ATM.
You talk to them with emails?
Yeah, exactly. So.
Yeah, it's very, you never know exactly but have you had any kind of customer client requests that got ahead of you, that you sort of were, because you've always been sort of, thinking and bringing, I think, customers and clients and partners with you. And what's been demand driven for you? Because what I think is interesting is when we all sort of first started talking about tokenization, at least from my perspective, it was going to be the illiquid assets that would be tokenized first, of course, because they're illiquid. What an opportunity. But it was not the illiquid assets. It was the assets that were already liquid that started. And you think back, it's obvious when you think.
Well, it's obvious because, by the way, they're illiquid. Just because you tokenize them doesn't make them liquid, right? You still need supply and demand. You still need buyers and sellers, and you need market makers, and they don't exist in the system. By the way, a great opportunity, which is market making on those real world assets that are illiquid, because there is demand for those. They're just like in the old securities industry. You had to create market makers. That is what the exchanges did originally, and we don't have that yet, and so that slows down, I think, the acceptance of that.
Yeah.
It's not the technology that's slowing it down.
Yeah. But as you think about your client base, what are they screaming at you for?
Well, again, our client base, we were much more front-footed in saying you should care about this. I mean, Sandy does. For those who don't know Sandy's background, anybody who was in the wealth business or the asset management business went to Sandy Call for the quintessential report on what is the future of it for the last decade plus. She interviews, I think in her annual report, interviews people who control 30 trillion plus in assets, 60 trillion, it's a big number, in assets to get kind of their understanding and things. And it was Sandy who just became passionate about, I see where this is going. By the way, she was one of the first people to call ETFs as going to be incredibly disruptive. And so what's happening is Sandy is now educating our traditional. They're in that a little bit of the education stage, but now they care. Now they realize they need to care. And then, as I mentioned, I think the DeFi firms that have clients, have wallets with clients, are also recognizing. There's a lot of them are talking about, should we have banking services? Should we have, offer investment products in there? And so this is why I think there's the convergence is starting to happen. Both sides are wary of the other side. We comfortably play in both. And so I think that gives us a really nice position.
Yeah, if you're sitting in this room, you don't know who Sandy Call is, you should be ashamed of yourself. You need to leave, exit stage left. Okay, so where's the organization now? Is everybody kind of all in, or how, for us, it's the world. For you, how much of your world is it? And
there's no way, I mean, the team gets tremendous resistance in there, and that's why they're kind of carved out. Now, less so, suddenly, here's when there's it's starting to matter. When your sales force, who, by the way, a sales guy is going to sell what's easy to sell. So they're going to sell what their clients are starting to ask them about. And so when your sales teams are starting to say, I need to understand this better. And that's what's starting to happen, is that because our traditional clients are starting to ask our sales guys, could you talk to me about this? And look, I think there was a aha moment when the Bitcoin ETFs took off, that it woke up the TradFi firms to saying, our customers care. Now, there's a lot of them who said, but that's all fine. We've done it in the ETF. We're done. We don't need 24/7. I talked to a huge platform in the US that has 24/7 trading. And the CEO said to me, 4.5% of our clients trade after hours. So I'm not sure that demand is there. Yeah, but the next generation doesn't think that way.
Right.
So you have to be able to kind of move ahead of where your customer is going to be.
Yeah.
And I think that's the part that is starting to happen.
If you think about the themes that we've explored so far, be it in general, moving an organization, having that, vision thing, moving an organization, to positioning yourself now for the next evolution in digital assets and traditional finance, to dealing with traditional financial partners, what you have to say to people that want to be like you.
I mean, well, first of all, I have to tell you, I mean, one of the things that like stresses me out, keeps me up, I have such fear that we're going to be the mouse sitting in the Xerox R&D lab when Steve Jobs walks through and says, I want to have access, right? I don't know if anybody, you guys know that story, but like Xerox had the mouse for a decade before they ever figured out how to commercialize it. And Steve Jobs, they made an investment in Apple, and part of his deal of the investment was, I get access to anything in your R&D lab. And so he's exploring the R&D lab, and he walks through and he goes, this is really cool. I want this, and then launches the Mac computer on it, right? And so how often, matter of fact, Oracle was built on a white paper that was done by other people, right? Like, so often you can have the ideas and not be the winner in commercialize. So like I would say, even within our own firm, we have a pretty substantial team focused on this. People ask me the question, how'd you get your board to agree? I didn't get my board to agree. We were doing this on the side. It was enough of a budgeted funded that you didn't talk to the board about it, because you didn't want the board to say, no, that's a waste of time. And when FTX blew up, I have VCs on my board who said, yeah, that good thing we stayed away from that area. Like we are justified in not being there. And so, a couple of things, like, I don't think we're sitting there and can declare success until you are really embedded and commercialized. And you have to be paranoid to be afraid that somebody can jump in after you. I mean, I think we have a really substantial runway, but jump in after you, if you don't get it right. So that's why I, as CEO, still spend a fair bit of time focused on this.
Okay, bullish or bearish?
Bullish on bearish of which part?
Just the future of digital assets.
Oh,
and
totally
acceptance.
bullish. No. I mean, look at it is going to take over financial. Blockchain is going to be the infrastructure of financial services. There's no question in my mind on that.
Okay, what a way to end, huh? Thank you.
Thank you. Yeah.